Well, Tata Steel, that's the stock in focus after its numbers came out, and it has been a poor set. There is no way to sugarcoat the performance that you've seen from Tata Steel in the second quarter. So let me pick up on that discussion point. We have with us Mr. T V Narendran joining in the show right now. Mr. Narendran, great to have you on the show, and I have to talk about Tata Steel Europe first, right? Because that EBITDA per ton loss that you've posted now for a fourth consecutive quarter, can we now say that the worst could be behind us? Because I recall when we were chatting with you post the first quarter numbers, you said that things are looking up and that second half is going to be better.
Yeah. So, Aisha, I think what I had guided at the end of the first quarter was that second quarter will also be challenging because there are two things happening in Europe. One is our UK business, which has always struggled in difficult market conditions. We continue that struggle, but at least we have a plan for the future and we are restructuring the business and all that is going on. But the other part of our European business, which has traditionally been EBITDA positive, cash positive, is Netherlands. And we are undertaking a blast furnace relining there. So 40% of our production is down because that blast furnace, we have two blast furnaces. This produces 40% and we have another one which produces 60%. So this blast furnace has been down since April and it will come back towards the end of November. So we've had 2 quarters with 60% production levels, and that has an impact on costs, and that's why we've had a negative EBITDA over the last 2 quarters. So we expect this quarter to be better in Netherlands than the last quarter, and in Q4 we will come back to the positive EBITDA territory from the Netherlands that we've always seen. So that's a story on Europe, and that's what is reflected in the numbers that you saw for Q2.
Sure. So I'm just going to reiterate and get it on record. You're saying with Q2's performance, both UK and Netherlands have bottomed out. Is that a yes or a no?
Netherlands, yes. UK is obviously nothing is changing apart if the market conditions improve. Of course, we will get better because UK, the big challenge has been some of the assets are coming to the end of life, and that's why we are taking up this restructuring. So there may not be a significant improvement in UK, but there will be better numbers coming out of Netherlands in Q3 and Q4 compared to Q2.
Okay. But tell me now that, coking coal as well as other raw material prices are also on the uptick once again. Where do you see your Europe spreads headed in the second half?
So obviously that's a challenge, but the reality is also that most steel companies, whether in Europe or in China, at these coking coal prices and these spreads are not making money. So, or at single-digit EBITDA margin levels. So as a consequence of that, we expect either the coking coal prices and iron ore prices to start moving down or steel prices to start moving up because this level of operation at this level of spread is not sustainable for the industry. You've seen announcements of blast furnace shutdowns in Europe. You're seeing production restrictions happening in China because and also margin losses in China. So I think there will be a correction going forward, either in prices or in volume, which will help improve the spreads in Q4.
Okay. I also want to talk about the UK restructuring because I think it's very critical right now. Because last month you announced this mega restructuring wherein the UK government also is going to make one contribution. How is it that you're going to be funding your share of capex of £750 million?
Yeah. So that's money we'll have to put into the project, but I think that's money which we feel is going to pay back on its own simply because when we restructure and transition into a new process route, which leverages the scrap that is available in the UK, the competitive position of Tata Steel UK will change, and it will be in a position where it can be profitable on an ongoing basis without support from India as we've been doing so far. And the 500 million grant support that we're getting from the government make sure that this transition is affordable in that sense of the term. We are also looking at some OPEX and policy support, which we are in discussion with the government. So the government has decided to put in money because they also see that at the end of this, you will have a sustainable business, which is greener and more suited for the future that we want to see for ourselves in the UK.
Right. Reports are suggesting that this entire transition of restructuring in UK could actually lead to a job cut of about 3,000 headcount. And please correct me if I'm wrong here, because they believe that EAFs are less intensive. Have consultations with labour unions already begun?
Yeah, the consultations are going on. I think, yes, we will need fewer, we will have fewer jobs than we do today because an EAF operation is more simpler than the current configuration. The exact number is what is being discussed with the unions. The informal consultations have started a few weeks back. All the details that the unions and the third party that they've appointed to look at the details have been given. They're supposed to come back with a proposal, and then the formal consultation will start. But so the process is ongoing, and I think that is what we are expecting to do over the next few weeks.
But I'm sure you have some back of the envelope calculation, right? How much would be the financial impact of this, headcount downsizing exercise? How much would the saving be?
So I think I don't want to get into specific numbers just now till the consultation process is over, because we are expected to have a meaningful consultation and look at all options presented by the unions. But all I can say is we have made provisions in Q2, not only for impairment, but for the restructuring costs. And that's why you see the one-off hit that you see in our results. So we've provided for all that.
Okay. But have restructuring costs been fully accounted for?
Yes.
Okay, great. The other thing I also want to talk about is domestic operations, obviously, because the India operations, thankfully, have shown a lot of resilience. How much volume growth do you foresee for H2?
Not much of volume growth for H2 because all our operations are running at full capacity. The only one which we were ramping up was Neelachal, which is also running at full capacity. So I don't see too much of volume growth, maybe a little bit marginal, because Neelachal was not operating at full capacity in H1. But beyond that, all our other plants are operating at full capacity. You will see volume growth next year, which is when the Kalinganagar 5 million ton completion would have happened. Some of the completion has already happened on cold rolling mill and the pellet plant. So you'll see the volume impact next year. The volume increase this year, if at all, is going to be about 500,000 compared to last year on an overall basis.
Yeah. Sure. And what about the India EBITDA per ton? Because it's already down 16% sequentially. Now with RM costs upping up, what could be the impact on spreads?
I think for Q3, what we are guiding is that we expect realizations to be about 2,200 rupees per ton higher in Q3 compared to Q2. And we expect coal prices, consumption cost to be about $10, $11 higher in Q3 compared to Q2. So you will see a margin expansion in Q3. Q4, it's still early to say because we're waiting to see what happens to the spreads over the next few weeks.
The other thing about that the street is worried about a little bit, Mr. Narendran, is that you targeted a $1 billion debt reduction each year, right? You failed to achieve that target in FY23. In the first half of FY24 as well, debt has only now risen to about 77,000 odd crore rupees. What is the deleveraging plan that you've put in place for the second half of the fiscal?
Yeah. So, so if you look at the second half of the fiscal, we will see better numbers coming out of Europe. That has been a drag for us in H1. And that was one of the reasons why, we didn't generate the cash flows that we thought we would generate in Tata Steel. As far as India is concerned, most of it is because we are reaching the final stages of the Kalinganagar expansion projects. So the capex numbers, which we had guided for 16,000 crores for the year, most of it for India, continues. And, so for us, the challenge is to balance the need to complete the Kalinganagar project and get additional cash flows coming out of that versus the debt reduction target that we had committed to. So we'll find a balance. We will see what is the best way to do that and see how best can we stay within the levels that we want to stay. But yes, it's been a challenging year as far as debt reduction is concerned.
Yeah, sure. What about the global macro environment, though? I mean, where is it that you see HRC prices actually headed?
So today, if you look at hot rolled coil prices, they're reflecting the fact that China is exporting about 8 million tons a month. In 2015, China was exporting 10 million tons a month, and that's when global steel prices dropped to a very low level. Thereafter, it went down to about 5 million tons a month, and then you saw steel prices more in the $600 to $700 or $600 to $750 range. When China exports at this current level, then you tend to see steel prices in the $500 to $600 range, hot rolled coil prices. So I think what is key is how much will China export going forward? I expect it to export less because one is most Chinese steel companies are losing money at these prices. So you're already seeing some of them cutting production. Secondly, in winter, some of the provinces put pressure on them to cut production. We've already seen two of the provinces which account for almost 40-50% of Chinese steel production put in some restrictions. So I expect exports to start dropping from the 8 million ton levels that we've seen for the last 6 months. And as it drops, the prices should start moving towards $600. Otherwise, this is not sustainable. At coking coal at $330, $340, iron ore at $115, and hot rolled coils at $540. I think that's not an equation that works.
Right. I have to clear the air on this. I know you've time and again gone on record and said that, you're focusing on organic expansion, not inorganic. But Vedanta is looking to sell its steel business. Would you be interested at Tata Steel?
I think we will obviously prioritize our organic growth. Just now, the focus is on completing the Kalinganagar expansion. We have a new plant coming up in Ludhiana. It's an electric arc furnace-based operation, which should come up in the next 2 years. So we'll focus on these two projects for India for now. We look at the international markets, we look at our balance sheet and plan the next phase of organic expansion because we have enough opportunities for organic expansion in India within our existing sites, and that we believe will be more cost effective for us.
Okay, so that's a complete no then for Vedanta Steel business, is it?
I didn't say that, but all I'm saying is our focus will be on organic growth.
Sure. What about NMDC Steel?
Our focus will be on organic growth.
Okay, I will leave you to that. Thank you so much for taking the time out.
Thank you. Thank you.
Thanks.
Thanks.